David, good to see you. So, if we're handicapping the incentives on both sides, the sense of urgency perhaps on both sides of these talks, where does that leave you in terms of what direction the negotiations might take, what the stakes are at this point?
Yeah, I think you've got incentives on both sides now. Clearly in China, the economy's slowing down. We saw that in the Apple results and other things like auto sales in China. And the trade war is definitely hurting China. So they would really like to make a deal in the next 60 days. But I think on the U.S. side, you have pretty good incentive, too. The employment numbers for December were outstanding, but the PMIs, which are forward-looking, suggest the U.S. economy is slowing down. The Apple results have got people nervous. We're moving into earnings seasons. So I think in the next 2 weeks, you very well will see some growing weakness in the U.S. economy, and both sides really have an incentive to come together and make a deal.
David, do you guys at Brookings have any sense of what a deal would comprise?
I've been arguing for a while that a deal is likely to have three baskets. First, China's happy to make some big headline purchases of agricultural products and energy, so you might get a big headline number above $100 billion. That doesn't really change very much structurally, but it's one important part of a political deal. The most important thing is China opening up new markets. They're willing to make some moves on auto, financial services, perhaps telecom, healthcare. So I hope the negotiations really zero in on specific market openings from China. And then you've got longer-term issues like intellectual property rights protection, which China can't change overnight, but there's some concrete things they can do, and they certainly could make some nice noise about strengthening that. So those are the three things I'm looking for.
So those really are three things that amount to concessions by China. I mean, do you actually think that China's going to go into this with an idea of, okay, here's our cost for getting out of these tariffs, as opposed to looking at the U.S. and saying they're slowing down too, we have a higher pain threshold. They have a president who knows what's going to happen with these investigations and maybe is not going to be in the strongest position in a little while?
Well, I would argue that these are all things China should have been doing the last few years, and there are plenty of technocrats in China who wish they'd been doing these things, but they have their own politics as well. So you could call them concessions, and that has a certain truth, but they're things that will help China's economy, and that's what makes this plausible that you get breakthrough in the political logjam in China. And they're worried that this trade war is going to escalate. If the U.S. follows through on 25% tariffs on everything from China, that's going to have a very measurable effect on the Chinese economy. So you've got that threat, and then you have the fact that they really need to do these things in their own economic interest.
So what happens to the Chinese economy if they do strike a deal? Does it recover?
Yes, I think it's slowing down mostly because of their own campaign to get leverage under control. The trade war is an additional problem on top of that. So they need to fine-tune their macro policies. They don't have the potential to grow as quickly as they did in the past, but they can certainly grow at 5.5% to 6%. And if they accept that, fine-tune their macro policy, then I think they stabilize. And if they do these reforms we were just talking about, that's going to be good for their economy. So that might push growth up a little bit further towards 6.5%. You'll certainly see a rally in their stock market if we get some kind of sustainable trade agreement between the U.S. and China.
Yep, sounds almost like the makings of a win-win.